Welcome back, Wealth Masters. At Master Wealth, we're committed to helping you improve your financial situation and secure a better future. So, today, we're going to go over some crucial measures that you need to take to help you towards a comfortable retirement. Whether you're beginning your financial journey now or making a fresh start, join us as we explore 6 critical steps to help you work towards a prosperous retirement. Remember, it's never too late to make informed financial decisions and pave the way to a brighter financial future. There's plenty of information out there about why it's crucial to start investing your money as early as possible. Essentially, if you kick off your investment journey in your 20s, you could be looking at a prosperous retirement. But what if you missed that opportunity and didn't begin saving when you were younger? So here's the question. What's your game plan? If you begin investing $200 a month at the age of 25 and continue until you're 65, assuming that's your retirement age, you can potentially accumulate over $1 million in your retirement account. On average, investments tend to grow by around 7% annually. This doesn't mean your money doubles each year, but it does mean your investments, on average, increase by 7%. By the time you retire, you could have well over $1 million saved up in your retirement account. Now, let's say you didn't get started with investing until a bit later, perhaps not until you were 35, due to various reasons. You might think it's too late, but that's not necessarily the case. You decide to follow the same pattern and start investing at the age of 45, contributing $250 per month and aiming for that same 7% return. However, it's important to note that while this approach will still help you build wealth, you may not reach $1 million by age 65. And retiring comfortably with just a few $100,000 might be a stretch. But what if you decide to take a more aggressive approach? You choose to double your investment and begin putting away $500 every month, even at the age of 45. With your current savings of $50,000, you'll still fall short of what you'll need for a comfortable retirement in the future. To live well in retirement, the typical American needs between $1 and $2 million. Even if you invest $1,000 every month, at this rate until you're 65, you'll have just under $1 million. However, these calculations are simplified and do not consider factors like inflation or variations in investment returns. So, what's your next move? Do you simply give up? Certainly not. You can't just throw money around without a clear plan. If you're just starting your journey towards financial security, stick around until the end of this story to discover exactly how you should be managing your finances. According to financial experts, by the time you hit 50, your retirement savings should be at least 5 times your annual income. If you earn $60,000 per year, you should aim for at least $300,000 in savings. For those making $120,000 annually, the target is $600,000. And for those with a $300,000 annual income, it's $1.5 million. If you haven't reached these milestones, don't worry. Many people never received proper financial education and lack fundamental knowledge about budgeting, saving, and investing. You're not alone if you didn't start in your 20s. If you're a bit late to the game and haven't saved much for retirement, here are the 6 steps you should follow in sequence to secure a comfortable retirement. It won't be easy, but it's achievable. Keep in mind that the order of these 6 steps is crucial. To start, let's emphasize the importance of having the right mindset. I can imagine what you're thinking. Mindset? How does that help me become wealthy? Well, you can check off all the other steps on this list, but it won't matter if you don't have the right mindset. You won't achieve financial success without it. First and foremost, you must believe in yourself and have the confidence that you'll attain financial prosperity. If you wake up every day convinced that you'll never retire comfortably or achieve financial independence, you're likely to be correct. I can't change your self-perception, so there's nothing I can say to convince you otherwise. No matter how hard you work, if you lack the right mindset from the start, it won't make a difference. Wealth begins in your mind before it manifests in your bank account. If you struggle in this area, consider reading some personal growth books to learn how to change your perspective. To succeed, you must think differently from the majority, which is why we refer to ourselves as the minority mindset. This can be challenging if you're surrounded by toxic company and a toxic mindset. You need to distance yourself from that environment and surround yourself with encouragement if you hope to uncover the secrets of financial success. Another important aspect of your mindset is the need to be on the same page as your partner's mindset. If you're married or in a committed relationship, it's crucial to share these same financial goals when you're aiming for financial success and prosperity. Whether your partner is your husband or wife, it's necessary to have an open conversation and work things out together. Making sacrifices and putting in hard work is part of the journey, so it's vital that both you and your partner agree on what those sacrifices entail. If you have children, it's also important to ensure that everyone in the family understands your financial priorities. Parents can sometimes feel pressured to buy their kids the latest toys or gadgets when they see other kids with them. It's important to avoid being the person who always gives in to their children's desires, because these small expenses add up. To get wealthy, you need to know your top priority. If becoming rich is a top goal for you right now, everyone in your household needs to be on the same page. This ensures your overall well-being. Most people want to avoid having their children take out student loans to pay for their education. To cover your children's college expenses, you might end up sacrificing your own retirement savings. So, what are the consequences of this decision? Your children may graduate from college, but they'll still have student loans to repay. And as retirement approaches, you may realize you have little to no savings. Consequently, your kids may not have a massive education debt, but they'll have to support your retirement years. In the worst case, they might even forget about your needs altogether, leaving you in a financial bind. Now, let's conclude the mental preparation by emphasizing that while the journey may be challenging, it's not impossible. Many individuals experience setbacks until their 40s, at which point they start making positive changes in their lives. In other words, achieving financial success is attainable. Some people who are now billionaires didn't start accumulating wealth until they were in their 40s or later. So, understand that it's possible. But if you're ready for the journey and willing to put in the effort, let's move on to step 2. The second crucial step to becoming wealthy is building a strong financial foundation. Think of it as constructing a house. The initial step in building a house is creating a sturdy foundation. Without a solid base, your house will be shaky and might even collapse. Similarly, in financial terms, it means you should start saving money and paying off high-interest debts as soon as possible. Begin by depositing a few $1,000s into a readily accessible bank account, especially if you don't already have any savings. Avoid investing this money in risky ventures like the stock market or cryptocurrencies. It's meant for emergencies. I understand that saving money during times of high inflation might seem counterintuitive. However, the purpose of saving money isn't necessarily to accumulate wealth. Many of us were taught that saving is the key to financial success, but this is a misconception that you should let go of. Whether you save or spend money, it should have a purpose. There are only 3 valid reasons to save money: for retirement, for unexpected expenses, and for major purchases. Don't hoard more than a year's worth of living expenses in savings. The recommended amount is typically between 3 and 9 months of living costs. However, if you're risk-averse, you can save up to a year's worth. Avoid stashing away more money than that because it could lose value due to inflation. Aim to save the equivalent of 3 to 12 months worth of living expenses, but no more. Once you've accumulated a few $1,000s in savings, your top priority should be paying off high-interest debt. Start by tackling high-interest obligations such as credit card debt, payday loans, and other short-term loans with steep interest rates. These high-interest debts are costing you money unnecessarily. While high-interest rates were once considered excessive at 10% or higher, even lower rates are now seen as high. Payday loans, high-interest credit card debt, and other short-term loans should take precedence over other financial obligations. If you're paying 15% interest on your credit card or loans, it doesn't make sense to try to earn 7% to 10% a year through investments. Instead, save a small sum of money and use it to make principal payments on your high-interest debt. If you've been accumulating items over the years and you're looking for a way to quickly achieve your financial goals, it's time to sell some of those unused items. Take a close look around your house or room. What unnecessary clutter is taking up space in your home? Selling these items can turn them into cash, which you can use to pay off debt. Additionally, negotiate for lower rates on your monthly expenses like utilities and put the savings toward your debt repayment. In American culture, haggling over prices is less common, except when purchasing a primary residence or sometimes a vehicle. However, you can try negotiating politely in other situations as well. I encourage you to start by contacting the companies responsible for your utility bills, electricity, water, gas, cable, internet, etc., and asking for reduced rates. If you're not experienced in this area, it might be challenging at first, but remember that rejection is the worst possible outcome. Additionally, if you research and find that their competitors are offering lower prices, you can use that information as a leverage in your negotiations. Businesses value their loyal customers and don't want to lose them, so use this to your advantage. It's more expensive and time-consuming for them to find new customers. The best tip for successfully negotiating lower bills is to be polite to the customer service representative. They often deal with frustrated customers, so treating them kindly can go a long way in getting a favorable response. The next step is to take control of your financial situation by creating a budget and setting goals for your savings, investments, and discretionary spending. Nowadays, every dollar you earn needs to be put to work effectively. If you don't allocate your hard-earned money wisely, you might end up wasting it on things you don't really need. So, don't let a single dollar enter your bank account without a clear purpose for its use. Many individuals share a common misconception. They assume that having a 401k plan suffices for their retirement savings. However, it is vital to understand that relying solely on a 401k is not a comprehensive retirement strategy. Even the person behind the 401k has publicly acknowledged its limitations. The reality is that your 401k was never intended to be the sole foundation of your retirement plan. If you find yourself in this situation, it's time to take proactive steps to regain control over your financial future. To establish a robust financial system, consider the benefits of automating your finances. By implementing an automated approach, you can effortlessly set up recurring investments, savings allocations, and spending budgets. This process also involves determining the ideal balance between your discretionary spending, your savings contributions, and your investment allocations. Automating these financial actions is not only efficient, but can also be accomplished at no extra cost when you employ the right financial tools. While many adhere to the belief that maxing out contributions to their 401k and individual retirement account or IRA is the ultimate path to wealth accumulation and retirement security, we have chosen a different path. Personally, we do not participate in a 401k or maintain an IRA. Instead, we prefer to take charge of our investments independently. This approach allows us to realize superior returns, optimize tax advantages, and maintain greater control over our financial assets. However, it's crucial to recognize that 401ks and IRAs can be highly suitable investment vehicles for many individuals, but it's equally essential to acknowledge that they are not exclusive options available. As you embark on the journey to formulate a well-rounded financial plan, consider the merits of adopting a straightforward strategy, such as the 75-15-10 plan. According to this approach, for every dollar you earn, allocate 75 cents for discretionary spending, 15 cents for investment, and 10 cents for savings until you reach your predetermined savings goal. To execute this plan effectively, it is advisable to maintain dedicated bank accounts for each of these financial categories. Automate transfers to ensure that your earnings are systematically allocated to their respective destinations, thus mitigating the risk of inadvertent spending of savings or investment capital. Now, let's delve into the primary avenues for growing your wealth: investing in companies, real estate, and commodities. These distinct investment categories offer unique advantages and considerations, and the choice among them should align with your financial objectives and personal preferences. Investing in companies is perhaps the most commonly understood method, often achieved through the acquisition of exchange-traded funds, ETFs, or index funds. This passive approach enables you to gain exposure to a diversified portfolio of companies without the complexity of selecting individual stocks. One effective way to implement this strategy is through dollar cost averaging, which involves regular, consistent investments in ETFs or index funds. Platforms such as M1 Finance are particularly useful for executing this approach due to their simplicity and cost efficiency. Alternatively, if you are inclined to invest more actively, you may consider researching and selecting individual stocks. This method requires a deeper understanding of fundamental analysis and a longer-term perspective. Another intriguing option involves investing in startups through crowdfunding platforms like WeFunder, Republic, or Start Engine. This method presents the potential for substantial returns but comes with higher inherent risk. Additionally, you can choose to invest in your entrepreneurial vision, funneling your resources into your unique business concept. This path offers the potential to amass significant wealth, but entails a substantial degree of risk. The second investment avenue to explore is real estate, a tangible asset class that generates cash flow through rental income. While real estate typically necessitates a more substantial initial investment compared to crowdfunding, it also offers the potential for property appreciation over time. Lastly, consider the prospect of investing in commodities such as gold, silver, or cryptocurrencies like Bitcoin. Gold and silver are often regarded as reliable stores of value, while Bitcoin presents a more speculative and volatile investment opportunity. When it comes to this investment approach, it's quite unpredictable and risky. So, it's best to put only a tiny part of your money into it. If you're wondering where to put your money according to your goals, here's the plan. First, cut down on spending money on things you don't really need. Let's start by talking about those 0% interest deals you've probably seen. Some stores let you buy something without paying for it right away. It sounds great, but it's like borrowing money and paying it back each month. Businesses like this because they hope you'll spend more. If you spend too much and can't make the payments, you could get charged 15% to 25% interest. Understanding what's an asset, good for your finances, and what's a liability, drains your money, is key. If something is a liability, it's better to pay for it in full rather than making monthly payments, even if it comes with a 0% interest offer. The rule of 5 says, if you can't afford to buy 5 of something, don't buy even 1. So, avoid buying things you don't really need. Now, let's talk about being smart with your money. Take your car for example. It loses value every time you drive it. So, it's better to own a car outright with cash rather than making payments, especially with interest. To speed up your journey to wealth, consider driving a car that costs $200 to $400 per month and save the money you'd spend on a car payment. You might think about replacing your $30,000 car with another $30,000 car in cash. But if you have $60,000 and you paid $6,000 as a down payment for your current car, think about buying a used car for $60,000. You won't have to make monthly payments, and you can invest the $24,000 plus interest you'd otherwise spend on a car. Once you're financially stable, you can choose to get that $30,000 car if you want. Enjoying a nice car is great, but spending all your money on it isn't necessary. We all love fancy cars, but even when financially wise people started earning a lot, they kept driving a cheap one. Why? Because they knew they could afford an expensive car, but they'd rather invest their money in businesses and real estate. Their focus is on securing a prosperous future for their family, which matters more than owning an expensive car. It's important to appreciate what you have. When you visit countries with fewer luxuries, you realize how lucky you are. You can cut back on things to build wealth faster, but you have to be willing to make some sacrifices now to have a better future. Think about your priorities. Is it more important to save for retirement and build wealth, or is it paying for your kids' college? If you focus on the latter, you might jeopardize your own financial future. Earning more money seems like the solution, but it's not that simple. Windfalls like lottery wins often lead to financial trouble because people don't manage the money well. Even when you get a raise, your expenses tend to go up. So, you need to earn more money, but also manage it better. Having a growth mindset is crucial. Instead of just squeezing more from your current income, think about how you can earn a lot more. This might mean getting a better job, starting a business, or finding side gigs. Building wealth takes time, like a marathon, not a sprint. Planning is vital. Consider things like life insurance to protect your family if something happens to you. Also, make a will or estate plan to avoid family disputes over your money. Have the right insurance in place and a team of professionals like lawyers and accountants to protect your wealth. Building wealth is a journey. Stay focused on your goals and remember that it's about making smart choices today for a better tomorrow. As we wrap up our discussion today, remember that getting richer is a long journey, not a quick race. With the right attitude, a strong financial base, smart spending plans, and clever investment choices, you can move towards a wealthier future. Stick to your goals, stay positive, and keep making good money choices. Here at Master Wealth, we're here to help you along the way, giving you useful advice to reach your financial dreams. Keep working hard, Wealth Masters, and never give up on your pursuit for financial success.